There's a $60,000 gap destroying deals in the Hampton Roads right now. Sellers are listing at $120 per unit. Buyers are offering $90,000. Same property, same market, same day. I'm Justin Ferguson, and in the last 90 days I've watched 3 Hampton Roads properties sit on the market for over 8 months because sellers won't accept what the data is screaming at them. In the next 10 minutes, I'll show you where exactly deals are closing, not where sellers wish they were, and what it means whether you're buying or selling in 2025. Here's what's happening on the ground right now. Buyers have completely reset their underwriting. They're requiring cap rates at 6.5% to 7% minimum. Some are pushing for 7.5% or higher, especially on anything that isn't Class A with stable military tenant concentration. But sellers, they're still anchored to 2022 valuations. They remember when cap rates were at 5 and 5.5, when debt was cheap, when insurance wasn't crushing NOI like it is today. The math doesn't work anymore. According to the latest CoStar data, the average sales price in Hampton Roads is $162,000 per unit over the past year, but that's heavily skewed by newer high-quality assets. When you look at the 3-star properties, the bread and butter, Class B and C assets, they're actually trading between $150 and $183 per unit depending on location and condition. The result? Deals are stalling. Properties sit on the market for months, tours happen, but bids come in 15 to 20% below asking. One side has to adjust or nothing trades. Let me show you what the data actually tells us about the Hampton Roads right now. So chart 1, vacancy rates holding steady. Hampton Roads vacancy sits at 5.5 as of Q3 2025. That's actually better than a national average of 8.1%. The market is showing fundamental strength. Vacancy for 4 and 5-star properties is even tighter at 5.1%, while 3-star assets run at 5.5. This isn't a 4 to 5% occupancy that sellers are pricing into their pro formas, but it's relatively stable. The issue isn't demand, it's pricing expectations. Chart 2, actual sales pricing by asset class. Here's where reality hits. Over the past 12 months, the average price per unit across all sales was $162,000, but when you break it down by quality, 4 and 5-star properties averaging $241 per unit, 3-star averaging $183 per unit, 1 and 2-star properties averaging $116 per unit. That $120,000 per unit sellers that want their B and C assets, 35% below where 3-star properties are actually trading. The market is saying these assets are worth more, but only if they're well maintained and in the right location. Chart 3, the cap rate reality. This is the chart that explains everything. The current market cap rate in Hampton Roads sits at 6.4 overall. For 4 and 5-star assets, it's at 6%. For 3-star, it's 6.4. Compare that to 2022 when cap rates were at 5% or below. It's a 120 to 140 basis point expansion. On a property generating $1 million NOI, that cap rate shift alone reduces the value by $3 million to $4 million. Sellers who are anchored to 2022 pricing are literally pricing their properties at cap rates that don't exist anymore. Buyers can't get financing at those numbers, and they won't accept the returns. Now let's break down where deals are actually happening versus where they're dying. Class A properties near military installation, Naval Station Norfolk, Oceana, those are still getting buyer attention. The 4 and 5-star segment saw average sales at $245,000 per unit over the trailing year, though cap rates have expanded at 6% where sellers expected 5% to 5.5% 2 years ago. Military housing allowances provide ability. Even here, buyers are demanding cap rates that reflect today's debt costs, not yesterday's. Class B and C suburban assets, properties in Chesapeake, Virginia Beach away from the water, Hampton, Newport News, buyers are requiring 6.5% to 7% cap rates minimum. Average sales prices for 3-star properties are running $183,000 per unit, with cap rates averaging 6.7%. Properties in these areas face higher maintenance costs, potential vacancy risk, and the reality that the rent growth isn't keeping pace with expense inflation. Insurance costs are crushing deals. I'm seeing properties where insurance has gone from $300 per unit annually to $900, even $1,200 per unit. On a 100-unit property, that's $5,000 to $7,500 in monthly NOI reduction that sellers often haven't updated in their pro formas. This expense shock alone is forcing cap rate expansion and reducing valuations across the board. Norfolk proper, properties close to downtown, near the medical district, are holding value better than the suburban inventory. Buyers see growth potential with infrastructure investments and urban revitalization. The cap rates have still expanded from 5.5% to 6% average in 2022 to 6.4% today. Virginia Beach is split. Properties with proximity to tourism and oceanfront remain competitive, but anything inland gets treated like suburban inventory. Buyers want 6.5% to 7% cap rates. Chesapeake represents the biggest change for sellers. Large properties, car-dependent locations, buyers view these as higher risk and require cap rates of 7% or higher to make the numbers work. Let me walk you through a real example from a deal. Let me walk you through a real example from the past year that illustrates this gap perfectly. A 288-unit property, Banyan Grove Apartments in Virginia Beach. Built in 03, good condition, 4-star quality. This will be sold in June 2025 for $69.5 million. That's $241,000 per unit at a cap rate in the low 6s. Now compare that to a 3-star 300-unit property in Pembroke Lake Apartments in Chesapeake. Built in 74, solid B-class asset This sold in December 2024 for $42.5 million. That's $142,000 per unit. Same general market, both Hampton Roads, but vastly different pricing based on quality, location, and buyer underwriting. Here's the stress test that's killing seller expectations. If you're a 3-star property generating $1.2 million in NOI and sellers want to price at 5.5 cap rate like 2022, that's $21.8 million valuation. But buyers are underwriting at 6.5 to 7% cap rates. At 6.5, that same $1.2 million NOI supports $18.5 million valuation. At 7%, it's $17.1 million. That's a $3.4 million to $4.7 million gap on the same property with the same income. Sellers anchored to 2022 pricing are leaving deals on the table, or worse, they're sitting on the market for 6 to 12 months with no offers. The market has moved. The question is whether sellers will move with it. So what does this mean? If you're active in Hampton Roads right now? For sellers, you have to price in today's buyer math, not 2022 valuations. Run your NOI at realistic expense levels, include current insurance costs, factor in actual vacancy, then back into pricing at 6% to 7% cap rates depending on asset quality. A closed deal at market pricing beats a stale listing at aspirational pricing. The data shows properties are trading $785 million in sales volume over the past year across 76 transactions, but they're trading at today's cap rates, not yesterday's. For buyers, focus on stress-tested returns, not seller asking prices. Underwrite what you're willing to pay based on your acquired cap rate and hold period. The market has shifted in your favor and disciplined buyers have leverage. Cap rates in Hampton Roads are running 6.4% overall, with 3-star assets at 6.4 and 4 and 5-star assets at 6%. Use that data to anchor your offers. For operators, NOI defense is everything. Focus on occupancy and collections, not aggressive rent pushes. With vacancy at 5.5 and rent growth at just 3.1 annually, every empty unit for an extra month costs more than any rent increase you might capture. Hampton Roads fundamentals are actually solid. Vacancy lower than national average, positive absorption of 2,200 units annually, and slowing supply pipeline. But pricing has to reflect current debt costs and cap rate environment. If you're looking to buy or sell in the Hampton Roads, don't guess where pricing is. The gap between buyer and seller expectations is real, but it's not insurmountable if you have the right data. So book a call with me. I'll walk you through where deals are actually closing, not where they're listed, but where contracts are getting signed. I'll show you how to bridge the gap between buyers and sellers in 2025, whether you're on the buy side or the sell side. The market has shifted. The question is whether you're going to shift with it or you're going to get left behind waiting for conditions that aren't coming back.